Welcome to the Global View, the show where we look at ways for investors to make money beyond the ASX-listed universe. I'm your host, Juliette Sarli. Well, US stocks wavered on Wednesday as investors awaited results from Alphabet, Google's parent, and Tesla, which came through after the closing bell. The Nasdaq led Wall Street lower, while the S&P 500 fell slightly and the Dow Jones index ended virtually unchanged. Traders also monitored the latest Middle East hostilities, which led oil futures to settle at a 6-week high, fanning inflation worries. The Philadelphia Semiconductor Index ended up 0.4%, recovering from early losses for its third straight session of gains after 3 days of losses that had confirmed it was in a bear market late last week. Trading was choppy in Alphabet, which closed down 1.5%, shares down more than 3% in extended trading after the search giant hiked its capital spending guidance for 2026 by $15 billion, reporting the best ever quarter of growth for its cloud computing division, driven by strong demand from AI-hungry enterprises worldwide. Tesla missed analyst profit forecasts for the second quarter and, for the first time in more than 2 years, reported negative free cash flow as the Elon Musk-led EV maker accelerated spending on infrastructure for its AI and robotics ambitions. After closing the regular session down 1.3%, Tesla added to losses in late trade, down around 3%. Shares in Supermicrocomputer were up by almost 20%, making it the S&P 500's biggest percentage gainer on the day after the server maker said it had secured more than $60 billion in new orders in the fourth quarter. IBM edged a little lower. It did confirm a cut in its full-year sales outlook that hammered the stock earlier this month. Among other movers, AT&T advanced after the telco firm added more wireless subscribers than expected in the second quarter, and Philip Morris International also higher after stronger cigarette demand helped the company beat quarterly results estimates. Meanwhile, Paramount Skydance on Wednesday gained EU antitrust approval for its $110 billion acquisition of Warner Brothers Discovery after agreeing to ditch a film distribution joint venture with Universal Pictures. Well, the conflict in the Middle East continued to dominate sentiment as US President Trump vowed to destroy an Iranian bridge or power plant every time Iran shoots at a ship in the Strait of Hormuz, raising the stakes in the war with Iran as Iranian-allied Houthis in Yemen threatened a second vital energy route. Iran's foreign minister posted on X that the country would retaliate, saying our defense doctrine is clear, an eye for an eye. Any aggression against Iran, including our infrastructure, will compel a powerful and decisive response. And the World Bank chief economist has warned escalating hostilities between the US and Iran could reignite inflation, drive interest rates higher, and knock global growth back to as low as 1.3%, down from 2.9% last year. Interest rate sensitive 2-year US Treasury yields climbed to a 17-month high, while the yield on the benchmark 10-year reached 4.66%, the highest since the 20th of May. And the dollar eased from a 1-week high after 4 straight daily advances. The yen saw a modest recovery from its weakest level in nearly 4 decades. And there was also focus on the pound, which held steady against the dollar as softer than anticipated inflation read in England did little to alter market expectations for interest rate hikes later this year, oil prices jumping as geopolitical uncertainty persisted. Oil prices, well, they settled at their high since June 11 on these mounting supply concerns, with Brent at $94.07 a barrel after hitting a high of $95.47 in the session. WTI was just under $87, and gold hit a 2-week high buoyed by the softer dollar and technical buying, and also following comments from US Secretary of State Marco Rubio that Washington is willing to negotiate an end to the Iran crisis, but Tehran, according to Marco Rubio, is not serious about the talks. Well, the AI arms race showing no signs of slowing down. Of course, we had Alphabet overnight. Joining us to discuss all the results is Kent Williams from Pi Funds. Good to have you with us, Kent.
Good to be here, thank you.
So let's talk about what we saw from Alphabet and specifically that CapEx spend around Google. How did you read the results?
Yeah, so obviously this is the most topical result of the night. That's the first of the hyperscalers that have come out. So we've got the next hyperscaler results coming basically this time next week. So the market was going to be hugely focused on this result. The earnings came out first. The earnings result themselves was fine, but obviously, as you said, it's really that CapEx number. So, I think for this broader semiconductor trade, what we really need to see is increases in CapEx. and we've seen that with the results. So it's, you know, their guidance has gone up by about 10 to 15 billion just for FY26. So it's now about 205 billion. What's important about that is it actually already the previous guidance implied a sequential half-on-half increase in CapEx that they'd already done. So that has now increased further. So you're going to see more and more CapEx coming through. And then more importantly, you know, the market obviously looks beyond sort of 1 year out. So I think with this broader semiconductor trade, the market is looking 2 years out. The qualitative guidance that the company's given for FY27 hasn't changed, which is a significant increase on 2026. So that remains, but that's coming off a higher base. So the big takeaway there is that, you know, semiconductors is probably the most topical trade in the market at the moment. They've done really well. They've pulled back. Everyone's waiting to see, you know, what these CapEx numbers are going to do. So for my takeaway from this, you know, if it can help investors, is that incrementally, it's certainly not a negative. I think the market needed to see this. It's healthy that we've seen a consolidation and now see this sort of increase in CapEx. Ultimately, we do need to wait for, you know, next week to see, you know, the other hyperscalers and what they do.
So when you look at the overall CapEx guidance there, do you still see attractive upside across the sector, or are valuations just too stretched at the moment?
In the semiconductor space?
Yeah.
It's an interesting one because, I mean, I actually don't call it the semiconductor space, I call it the AI hardware trade or the AI CapEx trade. So there's a lot of ways to be playing this. You can be playing it from, you know, the chip makers, the memory stocks, even down to sort of the engineering business that are actually building the data centers. You know, so there's a lot of stocks trading on really eye-watering multiples, but there's a lot where the earnings growth has actually really dominated most of the share price returns. So, you know, Japanese stock Kioxia, that's been a big memory name, that's done really well. That still trades on a really attractive PE. So I think, you know, there's a huge valuation dispersion around the market, but ultimately this trade's going to be a function of, you know, you break it down, it's the AI CapEx and it's the rate of change in the AI CapEx that I think people need to be thinking about.
And when you talk about the massive ecosystem, because there is a lot of opportunity, where do you see the best opportunity? Is it in AI chips? Is it in memory, foundries, semiconductor equipment?
So it's a good question. The way I think about it is it all hinges on sort of the CapEx and not just the CapEx, the rate of change of the CapEx 2 years out. That's what the market's looking at. So to come back to your question is, you know, how do you play that? There's always some little niche that people are talking about, could be substrates here or something else there. The way I've been playing it in both of our global funds is actually sort of mapping the whole value chain and kind of making sure that you have exposure to all parts of that value chain. So we've sort of got a bit of a spread. Instead of trying to cherry pick exactly which part of the market's going to do the best, you know, you've got this huge thematic, this huge trend. Make sure you've kind of got exposure across the thematic, across the trend. So we've got things from, you know, the companies that are actually building the data centers, the memory stocks, the chips. It's equities. You don't need to just play it in one way. So I think, you know, if investors kind of want to be participating in this, the sensible thing I think is to spread your bets. You'll get the upside by, you know, kind of managing that portfolio risk.
Outside of this very strong thematic of AI and semiconductors, where else do you see opportunities?
Yeah, good question. The one that's starting to look interesting to me now is actually the gold trade. So 2025 was all about, you know, that AI hardware trade and gold. 2026 has not been about gold. You know, gold's actually been, you know, sort of washed out. No one's really looking at it anymore. So why I think this is interesting is for a couple of reasons. Firstly, as I said, sentiment is just totally washed out. You know, you've had the incremental sellers. We've seen, you know, people move away from gold. So I don't think there's much incremental selling there. China is still an incremental buyer. So there's data that's come out recently on that. You can see they're very much that sort of structural buyer. Then you think about what does that actually look like, the setup. It feels like from, you know, looking at all the stocks and gold price itself, it's kind of finding a bit of a base and it's starting to look pretty interesting. So for me, I think this is one where if, you know, investors are trying to look at, you know, new ideas, something that could be interesting. I think gold, you still got time. It's early. I think it's one that people should be starting to revisit and think about. And there's just so many ways to play it through, you know, the developers, producers, explorers, ETFs, or just the gold price itself. So.
And of course, obviously closely linked to what we're seeing in terms of interest rate expectations. So looking out 6 to 12 months, where do you see that? Where do you see inflation, and how does that change your view on markets?
Great question. So this is hugely topical. At the end of the day, the direction of interest rates can really drive the direction of equities. I think we all know that. And I think it's really topical at the moment. You've seen the market flip from cuts to hikes. Now there's a bit of a spread between cuts and hikes. So you put that all together, this sort of rate cycle, we're actually starting from a higher base rates. Last cycle we came from zero, we're now actually a higher base. So there's actually a possibility for it to go both ways. Inflation is starting to pick up. You've got oil prices which are driving that core inflation. Plus, at the end of the day, this AI CapEx cycle is actually pushing up raw material inputs. So we're starting to see signs of that. But you put all that together, coupled with where interest rates actually are sitting now, and sort of where markets are kind of moving to, I actually think there's a good chance that we see more noise than signal around interest rates. They're at a point that it's not hugely restrictive or accommodative. We've got inflation a bit higher, and it feels like with every data point, the market shifts between hikes and cuts. So for me, at the moment, I'm waiting for a bit more signal on what the direction of interest rates are going to be. But I actually think at the moment it looks pretty, they could just kind of stay steady where they are, which is not a bad thing. The consumer's really strong. Earnings growth is holding up. If we get consistent rates, that's actually a really good setup for equities as a whole.
Kent, lovely to have you in the studio. Thank you so much for joining us. Kent Williams from Pi Funds. And just before we go, a quick look at where the local market is set to open in about 5 minutes' time. SPI futures up by 0.8%. That does it for this edition of The Global View. Stick around, the Open is coming up next.